Hello friends, last week in my video, I discussed what the mathematical probabilities were of the market falling or rising on budget day. I told you if you push me into giving you a hard number, I would say 51% of chances seem to indicate a fall and 49% probability of a rise. And sure enough, on budget day, market fell. Now, it was Friday that actually resulted in a very sharp up move. Now, the question on top of every trader's mind is A, is the Bank Nifty going to catch up with the Nifty 50 because it underperformed last week? And B, and more important, is the rally going to last or is this a mere technical pullback? So at the fag end of this video, the very last chapter, if you go into the description below this video, you'll see that the video is divided into chapters. The very last chapter of this video is all about whether the rally will last. Right now, let's jump into our usual video mode, and coming up on your screen is the market roundup window, and that tells you that it was the Nifty again that led the rally from the front, whereas the Bank Nifty continued for the third week in a row to underperform the Nifty 50. The US dollar index sort of witnessed a slight consolidation and it fell 4 basis points, and unfortunately that did not stop the rupee from weakening against the dollar, and that was a sentiment dampener. Because the Indian government reduced duties on bullion, import duties on bullion, gold and silver fell sharply. Crude oil and natural gas fell. As I have been telling you, there is no super cycle, including base metals, as you would have seen last week. I've posted a lot of content on my free Telegram channel. Please make it a point to connect with me. Now, the Indian 10-year benchmark bond yield continued to fall. It registered 2 basis points decline yet again, and that cushioned the decline for the Bank Nifty. NSE market cap was up 2.29%, and that tells you that the rally was fairly broad-based. Market-wide position limits, or MWPL, fell a little under 12%, and that is routine on expiry. We'll discuss this later. Where the US markets are concerned, on Friday, you saw a huge run-up. Still, net, technology-heavy NASDAQ registered losses. Widely held S&P 500. It was only the narrow Dow Jones Industrial Average that registered some gains, and that would also be one of the reasons why our market seemed top heavy. Friends, I share with you the ratio chart of the Bank Nifty versus the Nifty. You basically go to Trading View, in the search bar type Bank Nifty divided by Nifty 50, and there you have it. You will get this ratio chart. Now, what I have been telling you consistently since I've started sharing this ratio chart is that this ratio should be approximately 2.25 to 2.50, between that somewhere. That is when you would start expecting a sustainable rally. Unfortunately, for the fourth week in a row, and this is a weekly chart, the ratio has fallen, which means the Bank Nifty continues to weaken against the Nifty 50. Why is that important? Now, I keep telling you that nothing happens in financial markets without a reason, and since these are financial markets, the reason is also financial. Look at how the weightage is distributed in the Nifty. You would see more than 34% weightage of banking and financial sector stocks. The other heavy weighted sectors after the banking and financial sector, that means sector number 2, 3 and 4 put together, cannot match the weightage of banking and financial sector. So unless you have a rally in the Bank Nifty, forget about a sustainable rally in the Nifty 50. Now friends, I'm coming to our in-house indicators. I start with the market-wide position limits, or MWPL, which you know for a fact, as long as you've been associated with me long enough, forms a big portion of our study. It is a very good metric of level of commitment, both financial and emotional, on the part of traders. What we have seen is a routine decline post-expiry to 30.51. It happens to be lower than the low made after expiry in the previous settlement. That is the expiry of June series. That's not exactly very great. Also note how it peaked out at 42.05, which is lower than the prior series high of 42.22, which tells me that traders are not enhancing exposure at the current all-time high levels. This is one thing you need to keep in mind when we discuss the last chapter of this video. Friends, I now come to the turnover. This is a 3 cumulative series, so it is August, September, October. The turnover has jumped to the moon, especially stock futures turnover. It's at a period high of 20 weeks. As you can see, every 4 weeks this turnover jumps. Why is that? Because rollover happens. Now traders square up their exposure in the expiring month and initiate the same exposure in the next month. So it results in double turnover, which is why it spikes every 4 weeks. So we have seen turnover go to the moon, but MWPL has not risen too much. Now here is how evidence builds up in statistics and how traders who build statistical trading models learn to pick up the evidence from these numbers. What happens when the turnover it is a period high but MWPL is low? It indicates a high degree of churn. What is churn? You basically thrash about too much. You're buying and selling a lot, but you're not carrying your positions over. What could be the reason? Could it be that smart money is distributing their exposure? What you saw last week was distribution. I mentioned it in my video of last week as well. I also said it in my weekly Live Mint column, which is India's first and only media column to offer statistical inputs to its readers. So, can this change? Yes, of course, it can change anytime. But for now, it's a small red flag. Friends, I now come to the basis, which is nothing but the premium that the future enjoys or the discount that it suffers vis-a-vis the cash. Like options premium, this moves along with how much time there is left for expiry. Now, this is the beginning of the month, so the basis has jumped. Now, we need to watch whether the Bank Nifty's basis endures the 216 plus levels. Now, this kind of premium of the future is unlikely to sustain as far as I'm concerned because our statistical models are clearly indicating that. But these facts are carried on our free Telegram channel without fail late every night. And here are my contact coordinates on your screen right now. Please make it a point to connect with me. It's absolutely free and you can update yourself in real time. Friends, I now come to our in-house indicator, the impetus, which you've been enjoying since almost 4 years now. What you are seeing is the Bank Nifty impetus jump up. Now that's not good news. You would ask me why? Because higher impetus means higher force. If there is higher force, that means selling was forceful. Now that cannot be good news at all. The Nifty's impetus has actually slowed down, which is again not good news. Nifty has clocked gains, but there was no force. Now, when there is forceful selling but lack of forceful buying, this is not exactly very great. Friends, in my Live Mint column, I have often said that the Nifty and the Bank Nifty are like the two wheels of a bicycle called the market. What happens if one wheel is headed this side and one wheel is headed this side in opposite directions? Do you think the bicycle will continue to run or will it fall? Check out your screen. Do let me know. How do you expect the market to have a secular bull run when one index is down and the other is up? It can all change in one trading session, but as long as it hasn't, it's not done yet. So let's move on. We now come to the lift, weight, thrust, drag indicator, which you've been loving for more than 3 years now. And this is again something which our online family waits eagerly on our social media channels, particularly our free Telegram channel, to get updated every day. LWTD remains in the negative, although it has climbed, it has still remained in the negative. So what I would surmise from the reading is that lower levels are meeting somewhat improved short covering support, but buying is still not very proactive. Now, short covering can cushion declines. They can stop the markets from falling too much and too fast. But it cannot trigger a continued bull market. For a continued bull market, you need constant buying support, which is what is lacking. Friends, our in-house indicators done. I now come to the bond market, which is very close to my heart, and I've been monitoring this market ahead of the market since the last few years. I've been placing it ahead of equity because this market finances or funds the other asset classes. Now, the Indian 10-year benchmark bond yield continues to fall. Now that it's falling, that means bond prices are higher. No surprise here, because FIIs are buying Indian bonds now that Indian bonds are listed in the JP Morgan debt market indices. That is cushioning the mark-to-market position of banks who are the biggest investors in bonds in India, and therefore the bank Nifty is not falling as much. It's one of the reasons, not the only one. Is it okay to buy gilt funds? I'm asked this very often, especially after March, when I recommended that we exit the gilt funds at a profit. But after we exited, those NAVs have continued to climb. I'm still not convinced. At least I'm not buying any gilt funds as of now. When will I indicate you that gilt funds are a good buy? On my Telegram channel, first, foremost, and always. Because I'm not convinced that interest rates have peaked out yet. I have been telling you on my Telegram channel that interest rates are decided by check writers, not by central bankers. This is contrary to what you've been hearing in the media. Friends, the bond market's done. I now come to the bank Nifty, which lost ground last week. And as the daily chart on your screen tells you, that the 1.86% decline came because of declines on 3 out of 5 trading sessions. The bank Nifty has declined below its month-long moving average, even though Friday's close and Friday's candle was a big bullish one. The weightage of banking and financial sector services at 34% means that this sector must rally as soon as possible, otherwise the markets will feel the drag. Let's go to the weekly chart, which shows a third consecutive bearish candle with the price sliding into the bullish wedge. Now that basically tells you that bulls are not able to give proactive buying support to the bank Nifty. I've been telling you this since a couple of weeks that relatively speaking, the bank Nifty appears to be weaker than the Nifty 50, and which is not good. Remember the two tires of the bicycle called the market. The price is still above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook still remains more or less positive as of now. Friends, in the week before last, this index was placed at number 12 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It rose by 8 notches to number 4. That's not good news. Volatility is too high. I advocated an estimated range last week between 53,800 on the upside and 50,700 on the downside. Unfortunately, the downside was breached at 50,438 being the low in the spot. That tells you how much volatility there was. In the coming week, I estimate a range between 52,875 on the upside and 49,700 on the downside. Friends, in addition to these ranges, please also monitor the daily, weekly and monthly pivot levels that I update on our free Telegram channel. They'll help you laser precise your trade entries and exits. Friends, the bank Nifty done. I now come to the Nifty 50, which went on the front foot, and this index, like you can see on the daily chart on your screen, rose on only 2 out of 5 trading sessions, but the gains were coming from Friday alone, the week-on-week gain. Now that will be discussed in the last chapter in this video at the fag end, whether it's a pullback rally or a sustainable one, so don't go away please. Now the daily chart also shows you that the price tested the month-long moving average, did not violate it on a closing basis and jumped up, which means the market is respecting that moving average as a bankable support. Note how the Nifty did not breach this level, although the bank Nifty breached that moving average. So which is why I've been telling you the Nifty appears relatively stronger, and that is both good news and bad because of the weightage. If 34% weighted banking stocks are weak, it's like saying 1/3 of the market is falling and 2/3 is rising, and I expect it to continue rising. That's a little difficult to sustain. Let's now go to the weekly chart that shows you a bullish candle that logged an all-time high, and the price is above its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average bull. So the medium-term outlook appears positive for now. But friends, the difference between the price and the moving average is substantial, which tells me that there could be consolidation in the price going sideways and the average catching up with the price, or there could be a price-wise correction and the price coming and testing the average before rising again. In the week before last, this index was at number 14 on statistical beta rankings as per our in-house working. It fell by 5 notches to number 19, which means the beta or volatility fell, relatively speaking, because other individual stock volatility might have risen. So challenge level went down. Last week, I estimated a range between 25,100 on the upside and 23,950 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 25,425 on the upside and 24,250 on the downside. Please also refer to our daily, weekly, and monthly pivots on our free Telegram channel. They'll help you laser precise your entries. Friends, I now come to the retail risk appetite gauged by the footprint in the 4 derivative segments, and what you see on the chart on your screen is a weekly chart. The index futures turnover contribution went up by 1 basis point, indicated as a blue line. Stock futures turnover went up by 10 basis points, indicated as a red line. Index options turnover went up by 103 basis points, indicated as a green line. And stock options turnover fell by a whopping 115 basis points, indicated as a purple line. Why are these numbers so divergent from the recent averages? Hey, expiry. Now, turnover in futures is higher because it's logging turnover twice. Closing of trades in the expiring month, new trades in the coming month. So the real figures will actually come out from next week onwards. Let's keep our eyes on this as clearly as we can. Friends, I now come to my weekly trading strategy for the week ahead, and I've continued to maintain my view that I would continue to trade on smaller lots with larger price moves being expected. I would basically keep my tail risk or Hacienda hedges in place. It's explained very well in the video above. Please do make it a point to watch that. I continue to maintain my position that high MWPL counters will remain in trader focus because emotional and financial commitment is very high on these counters. Which means public sector units. Out of these public sector units, what will be hogging the most attention is public sector banks, oil marketing companies, power generation, power distribution companies, energy companies, as well as metal mining stocks. Why? Because I told you in the commodity markets, there is no super cycle, and metal prices, if they go up, will run into selling pressure. That will lead to volatility from up to down, and the stock prices of these metal counters will fall in tandem, which is precisely what happened. That I expect to continue to occur in the coming week as well. Do remember, this is the expiring month in the international commodity market for July. So there'll be a lot of thrashing about, especially when you come close to the end of the calendar month. So let's be careful out there. Oil and gas, like I have been telling you, in addition to base metals, is not in a super cycle. The super cycle is nothing but a figment of people's imagination, and the market price has validated that hypothesis. I will continue to seek theta decay opportunities in energy, and that's going to go on for at least the next couple of months till the vernal equinox, which coincides with the Holi festival in India. Barring the winter heating demand, I don't expect there to be another cyclical trigger point for energy to go up. Of course, hurricane season is still on till end of October, if not middle of November. So we need to keep watching that aspect as well. Now, the one thing that I draw your attention to is that on Friday night, the US markets jumped. I heard a lot of whoops of joy and celebration on WhatsApp groups, etc., that I'm a part of. But hey, if markets went up on the expectations of possibilities of falling interest rates, why didn't crude oil and natural gas go up? Why didn't metal prices go up? Why didn't bullion prices rise as much? Gold, of course, went up, but silver didn't. So that tells you that super cycle expectations are actually bereft of any mathematical logic at this point in time. The rallies in metal and energy will run into overhead supply, and it will trickle down to volatility in the stocks of this sector. Bullion fell last week because of the duty cut, and I do expect the overall bull market, which I have been advocating since months, to remain in place. As a matter of fact, on the budget day, I recorded a video specially for you about how to tackle the markets with higher STT in place and the cut in import duty in bullion. Please watch this video. As you can see the thumbnail on your screen, the hyperlink to all the videos that I want you to watch are in the description below this video and in a pinned comment below this video. Friends, I now come to the last segment, which I promised you I would discuss whether the rally on Friday in the Nifty was a pullback rally or a sustainable bull market. Now, Friday's up move was unique because of the amplitude, the sheer magnitude of the rise. It's not every day that you see a 400 point plus gain in the Nifty. So we need to analyze what really happened. Now, I told you that open interest has actually fallen, MWPL, as we discussed in the in-house indicators segment. But turnover was up. So the churn was higher. People didn't really create too much in open interest. They just traded intraday. And the churn tells you that traders are not convinced that they should take these positions overnight. That is red flag number one. MWPL, like I told you, needs to go up for me to say that, okay, you might be talking bullish, but are you trading bullish? So MWPL number 2 is another indicator I would watch in addition to churn. I want MWPL to go up. This is a metric that I update on my Telegram channel every single day late night. So please do connect with me. The rupee dollar peg, which I have discussed with you in my recent videos, is another pressure point. The more the rupee falls against the dollar, the more we are importing inflation, the more we basically are going to see pressure on financial assets. So in order for the stock market to rise from here sustainably, I would want the rupee to stabilize, if not start to strengthen against the dollar. The weightage aspect, of course, is something that I've been telling you, that the financial and banking stocks with a weightage of 34% must rise. Another pressure point that I noticed was the interest rate sensitives. Watch the screen very, very carefully. Do you see what I'm seeing here? See the performance of these interest rate sensitives. Now, what are interest rate sensitives? These are banks, non-banking financial companies, companies that depend on EMIs for sales, companies that are heavily up to here in debt and that are therefore very vulnerable to interest rate hikes. Now look at the performance over 4, 12 and 20 weeks of interest rate sensitive stocks. I've given you the total averages below in that picture. So that basically tells you that over all these time frames, 4, 12 and 20 weeks, these stocks have been underperforming the Nifty. And in many cases, even the Bank Nifty. That's not exactly very good news. For the markets to go up, remember their weightage is 34%. For the markets to go up sustainably, this segment must go up. This is something that you need to watch as a mature, scientific-minded trader. Now to sum it up, I would say last week's rally of the Nifty on Friday was not a bull move, not yet. We need support from all these pressure points that I told you. They must reverse and they must improve. Can it happen? Yes, it can happen. It can happen in one day, but till it's not happened, it has not really happened. So wait and watch. Remember the two tires of the bicycle. of the Bank Nifty and Nifty, the bicycle being the market. You want them to go in the same direction, not diverge. They go into divergent directions, the bicycle topples. We don't want that, right? Now take a look at the snapquote window on your screen. Another pressure point that I noted last week was the snapquote window saw very wide bid and offer spreads. Wide bid and offer spreads are the first telltale sign that the markets are feeling jittery. They are nervous. Markets talk to traders in statistical language, in the language of numbers. Are you hearing? If you're not hearing, you're missing out on something. So please pay attention. The bid and offer spread is the horizontal spread. The impact cost, the difference between bid number 1, 2, 3, 4, 5 is the impact cost. That's the vertical spread. Put together, the vertical and horizontal spread are called the spread quadrant. If the spread quadrant is hostile, which it was last week, it's not a bull market yet. Sorry, guys. I would want the spread quadrant to become trader friendly, which it wasn't. Friends, all this data that we need to monitor is there on our free Telegram channel. All you need to do is connect with us. And any more ideas, like I said, I would be happy to update on that channel itself. Friends, before I wind up this video, a reminder, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, please let me know how my videos are helping you become a better trader. Also, a request, please share my video with like-minded smart traders like yourselves so that my free channel can grow and spread the cult of knowledge-based investments and trading. Thank you for your patience in being with me in this video this long. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.